David Hirschmann. He is the President and CEO for the Center for Capital Markets Competitiveness in the U.S. Chamber of Commerce. The U.S. Chamber of Commerce is the world's largest business federation, representing 3 million businesses. Welcome.
Thank you, Chairwoman Velasquez, Ranking Member Graves, members of the committee. I really think this is a very timely hearing. Today what I'd like to do is to talk specifically about an issue of great concern to many of our members, especially our small business members, the proposed Consumer Financial Protection Agency. The U.S. Chamber supports the goal of enhancing consumer protection. In fact, the Capital Markets Center that I run was founded 3 years ago, before the current financial crisis, to advocate for comprehensive reform and modernization of our regulatory structure, including strong consumer protections. Consumers, including small businesses, need reforms that will ensure clearer disclosure, better information. They need vigorous enforcement against predatory practices and other consumer frauds, and we need to close the gaps in current regulation. However, the proposed Consumer Financial Protection Agency is the wrong way to enhance consumer protections. It will have significant unintended consequences for consumers, for small businesses, and for the overall economy. Today, the Chamber will release a study that examines the impact of CFPA on small business access to credit. The study is authored by Thomas Durkin, an economist who spent more than 20 years at the Federal Reserve Board. My remarks draw on the findings of that study to make the following points. Small businesses, including those we traditionally count, including those that we traditionally count on to be the first to add jobs in the early stages of an economic recovery, need access to credit to survive, meet expenses, and grow. Small businesses often have difficulty obtaining commercial credit and therefore turn to consumer credit and consumer financial products to supplement their short-term capital needs. The CFPA will reduce the availability and increase the cost of consumer credit. As users of consumer credit products, small businesses will see the same result, despite being fundamentally different than the average consumer. The proposed CFPA will likely restrict and in many cases eliminate small business access to credit, increase the cost of credit they would be able to obtain. This CFPA credit squeeze could result in business closures, fewer startups, slower growth, ultimately costing a significant number of jobs or that would either be lost or simply not created. Finally, the CFPA will only exacerbate the weaknesses of our current regulatory system without enhancing consumer protections. In 2006, 800,000 businesses created new jobs in this country. 642,000 of them had fewer than 20 employees. Small businesses generally have trouble borrowing money. Either they can't borrow, they cannot borrow as much as they need, and almost certainly they cannot secure long-term financing available to larger companies. To supplement the reduced access to traditional loans, small businesses rely extensively on consumer lending products, and they use them as a source of credit very differently than consumers. In other words, personal credit is the lifeline that sustains small businesses, particularly startups. Many of the products that small businesses rely on may be considered to some as fringe products, but they are the very products small business owners use to meet their short-term capital needs. As just one example, auto title loans provide small business owners with immediate access to cash and no upfront fees or prepayment penalties, and therefore can be very useful with meeting short-term business expenses. However, the CFPA and its approach to regulation failed to recognize the difference between small businesses as average consumers, both in terms of need and sophistication and their appetite for risk. As proposed, the CFPA will likely reduce the availability of these products and increase their costs. It will make it harder for financial firms to meet the needs of small businesses. The CFPA will create considerable new risks to lenders in terms of regulatory fines and litigation risks from extending credit to small businesses. H.R. 3126 is the wrong approach. It simply adds a new government agency on top of an already flawed regulatory structure. As one example, rather than streamline consumer protections to eliminate gaps or regulatory arbitrage and create uniform national standards for key issues like disclosure, the legislation would foster a complex and confusing patchwork of 51-plus state regulations in addition to new federal rules. As we begin to see signs of economic recovery, we need to be especially careful to fully understand the impact of a whole new regulatory layer on small business, both as consumers and as providers of financial products. We look forward to working with the members of the committee on comprehensive modernization of our regulatory structure and appreciate your holding this hearing today.